Welcome back, future management accountants and business leaders. Today, we're diving into an explainer that sits right at the intersection of cold, hard math and human behavior. We're going to examine the core theme of balancing the mechanics of profitability with the absolutely crucial guardrails of professional responsibility. It's really not just about finding a price. It's about understanding the real weight of your decisions.
I want you to chew on this question as we go through today's material. Is the right price always the ethical price? It's a massive tension every single financial professional faces. How do you balance the intense pressure to maximize profit against the absolute need to maintain ethical integrity in your business decisions?
Okay, let's quickly look at our roadmap for today. First, foundations of pricing decisions. Second, strategic pricing policies. Third, ethics and corporate governance. Fourth, professional accounting standards. And finally, real-world ethical dilemmas.
Let's kick things off with Section 1. Foundations of Pricing Decisions, the Mechanics of Profitability.
Before we can even begin to talk about strategy, we have to master the mechanics of profitability just to ensure the business survives. Let's start with customized products. Think of an accounting firm, a custom furniture maker, or maybe an engineering project. Because these services are totally unique, there just isn't a comparable market price out there. So what do? They use a model called cost-plus pricing. You take your direct variable costs and direct fixed costs, and that gives you your total direct costs. Then you add in your indirect overhead, and bam, you have your total cost. Finally, you add a target market percentage, which is your desired profit margin, to arrive at your selling price. To put that into perspective, let's say your total costs are 3,800 rands, and you want a 35% markup. Your target selling price then becomes 5,130 rands. At the end of the day, sales revenues simply must cover the entity's product costs and a profit margin for the company to keep the lights on.
But wait, here is the hidden danger in cost-plus pricing. Mathematically, it looks flawless, right? It's super easy to compute, and the numbers look highly precise and completely defensible. It feels safe. But the major limitation? It completely ignores customer demand. It literally assumes price should depend solely on costs. And here's a surprising fact. So many legendary product flops happened simply because companies assumed cost alone should dictate the price. Imagine you price a product at 1,300 rands based on an estimated volume of 10,000 units. But then, actual customer demand drops, and you only sell 7,000 units. Well, those fixed costs are still going to sink your company, resulting in massive losses, even though you technically priced above cost.
Moving right along to Section 2. Strategic Pricing Policies, Navigating Market Entry.
Now let's pivot from those customized products to non-customized, market-based products, like retail consumer goods or standardized manufacturing products. Here, competition and perceived value completely dictate the rules. Sometimes companies use what's called target costing. That's where they take the market price, subtract their desired profit, and then literally engineer the product backward to hit that strict target cost. But how do you set that initial market price in the first place? Well, we usually contrast two really powerful strategies. Price skimming involves charging a super high initial price to take advantage of novelty. This is absolutely perfect for highly unique tech gadgets with no close substitutes. It safeguards against unexpected cost increases, but yeah, it definitely alienates price-sensitive customers. On the flip side, we have penetration pricing, which means charging a very low initial price. The goal here is rapid market acceptance and aggressively discouraging competitors from even entering the space. However, the huge risk is that it can diminish the perceived value of your product, making it virtually impossible to raise prices later once buying habits are fully formed.
And we have to see how these strategies actually evolve, because products have a life cycle, and your pricing strategy must adapt to changing market conditions. It's like a giant cycle. In the introductory stage, you launch the product and build awareness. Then comes the growth stage, where sales expand rapidly until you start exhausting potential new customers. By the time you hit the maturity stage, demand really tapers off. Finally, in the decline stage, sales diminish as the product gets replaced by newer versions. Maximizing your profits means understanding exactly which stage your product is currently in and adjusting your price, either upwards or downwards, to create favorable demand.
So we've looked at the math and we've looked at the strategy, but hey, what happens when management is breathing down your neck, pressuring you to manipulate these very pricing models just to hit a short-term financial target? This is exactly where the real world gets extremely complicated.
That brings us to Section 3, Ethics and Corporate Governance, the Professional Guardrails.
This is where the professional guardrails come into play. As a management accountant, you have to realize that the numbers you produce aren't just digits on a screen. They represent massive decisions that impact employees, shareholders, and society as a whole.
Good corporate governance completely relies on accountability, transparency, and responsibility. Ethics isn't just some abstract theory you learn in a classroom and forget about. It is a vital, practical toolkit for navigating the really messy gray areas of business.
Let's look at the rulebook in Section 4, Professional Accounting Standards, the CIMA framework.
We are going to look at the framework established by professional bodies like CIMA, the Chartered Institute of Management Accountants. There are 5 fundamental professional standards you absolutely must know. The first one is integrity. This simply means being straightforward, honest, and truthful. In practice, integrity means you don't just blindly run whatever pricing models management asks for. You ensure those models reflect the honest, true financial reality of the business with zero deception.
Next up, we have objectivity. You absolutely cannot allow bias, conflicts of interest, or the undue influence of others to override your professional judgment. When you're sitting there setting target costs or calculating markup percentages, those calculations must be based strictly on facts and rigorous analysis. They must be completely unswayed by internal company politics or someone's desperate desire for a quick end-of-year bonus.
The third standard is professional competence and due care. You have an ongoing duty to maintain your professional knowledge and skill. Calculating complex product lifecycle pricing or executing a tricky price skimming strategy requires rigorous, up-to-date competence. And let's be real, a lack of competence here doesn't just mean you get a bad grade. It can literally lead to disastrous financial miscalculations that could tank the entire organization.
Fourth on the list is confidentiality. You must respect the confidentiality of the information you acquire on the job. Think about it for a second. If you're part of a core team designing a highly sensitive, aggressive penetration pricing strategy to capture market share, leaking that information to external competitors would absolutely destroy your company's strategic advantage.
And wrapping up the big 5, professional behavior. This is kind of the ultimate umbrella. It means strictly complying with all relevant laws and regulations and avoiding any action whatsoever that might discredit the accounting profession. Following this protects your personal reputation, and it protects the reputation of your organization in a highly competitive global market.
Let's put this into practice with Section 5, Real-World Ethical Dilemmas, Applying the Standards.
Let's see what actually happens when the mechanics of pricing and these ethical guardrails collide head-on. Put your management accounting hat on for a second. Here is your dilemma. You are launching a new product using penetration pricing, but suddenly you discover a massive cost overrun in manufacturing. Management aggressively pressures you to hide or ignore this cost data so they can falsely maintain that low introductory price and hit their volume targets. So what do?
This is the crucial point, how you respond. The professional standards give you a very clear, structured pathway out of this exact corner. Step 1. Identify the breach. Hiding costs clearly violates your objectivity and your integrity. Step 2. Stand your ground and flat-out refuse to manipulate the cost data. Step 3. Clearly communicate the true financial impact of the cost overrun to management. You need to show them that selling below the true cost will absolutely destroy the company's bottom line. And finally, Step 4. If that undue pressure continues, you utilize your company's corporate governance framework to escalate the issue to higher authorities, like an audit committee.
As we wrap up this explainer, I really want to leave you with a real brain teaser. You're learning all the formulas, you know the life cycles, and you understand the strategies. But when you're actually out there in the trenches of the business world and the numbers demand one thing while your ethics demand another, which scale will you balance first? Always remember, your true value as a financial professional lies not just in your ability to calculate the price, but in your courage to know its true cost. Thanks for tuning in.